Here's Joe. He's in Hamilton. Hi, Joe.
Guys. Yes, my question is on Talisman. I'm underwater on that one, but I'm up on Suncor in the same in the same account. I was thinking of selling Talisman and maybe going to a Tech Resources or maybe an Apple for just a switch of pace. Being it's in the same account and I can offset one for the other for the loss and the gain, would you recommend that? And what do you think of my move to one or the other?
Right.
And I'll listen to your answer. Thank you.
Okay, so there's a bunch of questions there. First of all, Talisman is a serial underperformer. It's been underperforming the group significantly. If there is additional weakness in price of oil and gas, it is likely to break lows. I think you have to keep in mind we are headed into shortly October, November, which is tax loss selling season. A lot of people with gains, people will be looking to take losses. So you should be looking at names that have underperformed over the last couple of years as potential candidates for sale over the next 2 months. I would be a seller of Talisman. If you say, should I look at Tech or look at Apple? Tech is in the wrong group too. The metals group really looks weak. They have a basket of commodity producers that they own. I would stay away from Tech. It's trading near the lows, and again, it was probably in the same boat. Apple, on the other hand, I think longer term has some real tailwinds, and they have some very attractive characteristics. They're a very consistent cash flow generator. They've got a really, really strong balance sheet. They've got shareholder-friendly policies to pay out more dividends over time. The long-term trend is behind Apple. I would be a buyer of Apple.
And speaking of Apple, Tim Cook back on stage in California. We, of course, are live streaming the event at BNN.ca, and he's getting to the payments portion of the presentation. So we'll see what comes out of that. A lot of talk about a mobile wallet. Dave's in Nanaimo. David Burrows is keen to talk about this company. Go ahead, Dave.
Hi there.
Hi, Dave.
Phoning about Disney stock. Just wondering, it's obviously had a pretty good run now, and with the upcoming Star Wars movies, is that going to make a big change with the bottom line?
Sure. So, Dave, there's a lot of drivers behind Disney, but Disney is benefiting from the same tailwind that the whole U.S. economy is benefiting from. The U.S. economy is 72% the consumer, and with falling food and energy prices, with falling financing costs, low mortgage rates, with less strain from commodity prices, they have more money to spend. So the U.S. consumer has more free cash flow to spend today than at any time in history. So the first thing people spend money on is travel and entertainment. And Disney obviously is the big leader in that space. It doesn't hurt that they've got such strength in media. And of course, in the movies, they've got a bunch of franchises that really start to hit over the next year. So we think that they're firing on all cylinders. They will continue to benefit from the current environment. If you get gasoline prices continuing to back off, people are going to have more money to spend at Disney. I'd buy the stock here. I think this is a core holding in portfolios.
Okay, this is unfair. Just a one-word answer. If you had the proverbial gun to your head, Disney or Apple, which do you choose?
Look, at Apple today has run up into this event. It could pull back short term.
Right.
You know, if I had to buy one, probably Disney.
All right, you did it. Brian's in Lindsay, Ontario. I believe this company's connected to Apple. You're going to talk about. Hi, Brian.
Hi. David, I'd like your opinion on NXP Semiconductors.
Sure.
Recently, it was one of your top picks. I'd appreciate your comments. Thank
you. So, Brian, semiconductors have been a leadership theme in this market. I think that semiconductors are the new copper. So they're a great indicator of economic activity. There's very short cycles, inventory cycles in semiconductors, so you very often know when things are slowing down because the order book dries up. NXP within semiconductors makes near-field communications chips. The chip that allows you to pass it by a reader and use it for a payment. So we're going to see today whether Apple comes with some kind of payment system.
Yeah, just now, Apple introduces a new payment process called Apple Pay.
So
nice timing.
It will be interesting to see if that includes an NXP chip. I think likely it does. It's possible that it doesn't. But NXP is the leader in this space, and we think that they have a very big market opportunity. So watch how it trades today. But we own the stock in anticipation of a growth in mobile payments.
We've got a market call minute coming up. One more question before that. Natalie is in Toronto. Go ahead, Natalie.
Hi, thank you so much for taking my call.
Sure.
Mr. Burrows, I bought American Tower at your recommendation a while back. I did very well. I bought it at 79. So I wanted to know your outlook now. Should I continue to hold it? Is it time to sell and go into something else? What do you suggest? Thank you.
So for those that don't know, American Tower owns cell towers, and they own them around the world. And in effect, this is a REIT that owns real estate. The real estate is cell towers. Their tenants are the phone companies who put their gear up on the tower to transmit and receive. So we know there's a boom in data use. And as that booms, more equipment has to go up in these towers. The average tower has 2.5 tenants. They could go to 5 tenants over time. When they come with new generations of gear, they don't take the old gear down because people still have a 3G phone. They put the new gear on top. So it's like an apartment building where you can just keep adding new stories. And so the opportunity for them is, A, to continue to grow their existing intensity of their towers, but they can continue to make acquisitions because it's a very predictable business. Their cost to borrow or raise money to grow and make acquisitions is very, very low. So we like this as a dividend growth story and one that is highly predictable.
Plenty of demand for you today, David. We've put a bunch of questions together in the Market Call Minute. Okay, John in Aurora, BC, he called in, Aurora, Ontario, called in about CIBC.
Canadian banks put up great earnings. Most companies beat on their wealth management businesses. I'd buy CIBC. We own the shares.
Herb in North Vancouver on one of the super majors, ConocoPhillips.
ConocoPhillips should benefit. Their refining margin should benefit from falling energy prices. It will trade like the rest of the integrated oil companies, going to be somewhat dependent on the price of oil. You could buy it here, but the risk is falling oil prices.
Patrick in Montreal on Surge Energy.
Again, this is one that is dependent on energy prices. It's a growth stock. It's one that I would buy relative to the peer group.
Cliff in Perth, Ontario on TransAlta.
TransAlta, a serial underperformer. I'd stay away from the stock. This is an industry that's booming, and they're having a difficult time.
Last one, another energy question. Peter in Richmond, BC called in about Crescent Point.
So at risk due to energy prices, however, they have a shareholder base who have bought this for the distributions and dividends and is one that will pay you along the way. So if you're going to have energy exposure, this is a good one to own.
So it's a good defensive play in a way as well.
Good defensive play. They've just done an issue, so that stock's going to chop around a bit in the next little bit, but we own this one in the portfolios.
Okay, David, nicely done. Nice and concise. So we'll come back with David's top picks after this.